because this article said, right, we needed to be able to predict financial crisis in 2020 for the pandemic. Let's put SPY here and see if cheat code would have been able to predict it. I have no idea. Let's take a look. I'm excited. Moon Platoon, you know what will really fix that economy? Ugh. Ugh. Oh man. Okay, anyway, back to the show, guys. We are going to cover this article by Mr. Brett Arends. The market will collapse by the end of June. Really? Well, if you guys have been asking questions like, should we pull our stocks out of the market right now, or maybe just a certain amount of them to even out with taxes? Should we be prepared for a catastrophic error, and how to know when that error is about to emerge its little head, like back in 2020 in March, or has it already begun and is it too late? Let's make sure that we pay attention to this article until the very end. Smash that like until 1,300. That's the number we're looking for. And if it's not quite there yet, drop a comment on which number you were, and let's go on straight ahead. So these forecasts always generate a lot of attention, and that's true. Well, the 401k death watch is underway. Now that should have been the title of the article to begin with, I think, because we know for a fact that the market crash is not only going to affect people who actively invest, right, with their little portfolios with different brokers, but also with your retirement funds, right? Your 401ks. The way that the market works is a lot of people have a lot of thumbs in your pie, your retirement fund. And if certain number of them have taken risky bets and they have to get margin called, they will be taking their thumbs out of your pie, leaving a big hole where you might not be able to recover for a good amount of time. A huge collapse is coming, warns longtime market prognosticator Harry Dent. He adds this thing will be hell. It could be the biggest crash ever and the start of the next big economic downturn. When? By the end of June, if not sooner, it seems, and that's less than 10 weeks away. Dent's forecast seems to have struck some kind of chord. For about a week or longer, the article was the most popular article at thinkadvisor.com. But although he may have been unique in setting a deadline, he's not the only guru predicting disaster. First of all, guys, make sure that you understand that these gurus, when they try to pass themselves off as financial advisors, never take financial advice from a video like this one, the one that you're watching right now, or an article like this one. It makes little sense to be able to follow people who, once again, are likely 20% guessing, at least 20% guessing, because they have to look at the predictors, the data. Data is king, but perception is queen. Perception is very important to be able to take into the steps where a mass of people are going to be following your lead, right? And that's a scary position to be in. I do not envy whoever this Harry Dent is. Just this week, they received a note from Jonathan Ruffer, an eminent money manager in London, with this dire warning. They take it pretty much for granted that the 40-year bull market is ending, and that will be replaced with a hard investment times. Jeremy Grantham, also born in England but long based in the US, recently concluded that stocks, bonds, and real estate are all in a bubble and may well collapse together in the next year or two. Long-standing gloomster John Hussman estimates the S&P 500 SPX could end up losing us all money over the next 20 years, even before you deduct inflation. Move it a little bit over here. And suspects a quick 25 to 30% market slump may be ahead. They have a guilty secret. They're a sucker for these warnings. Okay, maybe not dense. They often make for compelling reading. The most bearish stock market forecasters are generally more intelligent, more free-thinking, and more interesting than the average Wall Street salesman. They usually write much better too. Hussman's math and logic are almost unarguable. Why, asked John Wesley, does the devil have the best tunes? They're not comparing these people to the religious devil, of course, only to Wall Street's equivalent, sinners who may interfere with the business. Their arguments make plenty of sense, maybe not those predicting a market collapse in the time of Wimbledon, but those warning us of grim years ahead. The US stock market is 90% the level where the Warren Buffett rule is supposed to trigger red flashing lights and the deafening warning sounds. The so-called Shiller, or cyclically adjusted price to earnings ratio, the Tobin's Q, all sorts of measures are telling us that some version of aliens danger, the emergency destruct system is now active, the ship will detonate in T minus 10 minutes. Come on, typos. Run, don't walk to the escape pod. Don't forget the cat. And the most bullish forecast we hear from Wall Street involve the simple fallacy of double counting. The more stocks rise, the better their historic returns, which a salesman then cheerfully extrapolates into the future. Ergo, the more expensive stocks are, the more attractive they are. That's the human psychology element behind it, right? You have probably found it very difficult to ignore buying a rip. Whereas, remember, the motto is buy the dip. And so if you buy the rip, it just might seem like the right thing to do, but piling on really is perhaps catching a runaway stock, or even worse, trying to catch a falling knife. The bears have had plenty of logic and math on their side, but most of them have been predicting various reruns of the Great Depression for most of the past 20 years. Not just in 2000, 2007, which were good times to get out of the stocks, but also the rest of the time, which weren't. Over the past 20 years, a simple US stock market index fund such as the SPDR, S&P 500, or Vanguard index fund had quintupled your money, right? You can imagine that. An ETF, a fruit plate, a fruit basket of stocks, just getting jumbled up and still quintupling your money when you didn't have to do any of the heady stock market research that if you joined us for the live streams, you would be able to see pretty clearly. We go bell to bell, and we'd like to see you here. If you aren't yet subscribed yet, we're on our way to 80,000. We'd like to see you there with us. These forecasts are always guaranteed to generate a lot of attention. More important, fears of a market crash have kept vast numbers of ordinary people out of stocks completely. In their day-to-day conversations, they're struck by how many otherwise sensible people think not simply that the stock market is risky, but that you can and possibly will lose everything. So, if you guys have lived through the last financial crisis in 2008, if you guys lived through the crash of 87, if you lived through the Great Depression, now some of you are out there watching this video right now, you will know markets really do refresh and recover, even past the market crash of last year. Some of you might be very, very wealthy, 50, 100%, 200% up on buying that dip. Why is this, and why do I, like many others, find myself peeking at the latest iceberg warning? It's hardwired into us, psychologist Sarah Newcomb tells us. Warnings trigger our body's stress and fight or flight responses. The story may be that the market boom will move us slightly, but the story that the market crash moves us even more, right? This is the stick the carrot routine that every day you're probably experiencing for almost every decision. Newcomb, a PhD in behavioral economics, is the director of behavioral science at Morningstar. I guess it all goes back to the eons where our ancestors are roaming. Okay, let's not get off topic here. The prospect theory guy, Daniel Kahneman and Amos Tversky, one of my favorite two psychologists here, also found that we feel more pain from a dollar we lose than we feel joy from a dollar we gain. Prospect theory. If you guys search on this channel, one of my oldest videos is about thinking fast and slow and prospect theories. Are more attuned to any storytelling that they were about to lose money and to storytelling us we're likely to gain. So think about the incentives once again. We saw the war game for GME. In essence, it gives us the sense that people are trying to game the system here. So by reading this article, you have a better understanding of exactly what to expect and the kinds of people that are trying to tell you that story and what they are incentivized to actually tell you. Even if skeptics turn out to be right, what will happen? Will the market go up 10, 20, 50% before it turns? What will happen in June this year? There are options. Instead of trying to guess on boom and doom, we can let the market decide for us. Money manager Meb Faber worked out years ago that pretty much every stock market crash or bear market history has been signaled in advance. If you cashed out when the market index first fell below its 200-day moving average, you avoided nearly all the carnage. Okay, in the sudden 1987 one-day crash, you got all of a single day's notice. So at least you had 1 day in advance. Even if you didn't end up making more money in the long term than a buy and hold investor, he found you made pretty much the same amount and with far less volatility and sleepless nights. Yeah, make sure you guys are getting plenty of sleep. Make sure you guys are stretching. Last year, this trigger got you out of an S&P 500 on March 2nd, just before the main implosion. The market rose above the 200-day moving average again, triggering it was time to get back in on June 1st. So let's actually pull that up. Let's go off and take a look here. If we pull the S&P 500 over here, S&P, oh wait, let me just do the SPX. Let's do SPY. And move out to the daily, maybe I have to do weekly. What I have here is that 15-day moving average. What it wants you to do is the 200-day moving average here. So what I do is go into indicators on Webull, go to edit indicators, change my moving average to 200 days. Done. Let's get rid of these drawings for a second. And then all we need to do is go all the way back to March 2nd here. When this price action got below this blue bar here, it was time to get out. Well, that's pretty obvious. Hold on a second. March 1st. Look on the daily. There. Okay. So this is the daily chart here. Around February 27th, we passed below that $300 mark here. So whenever this price action goes below the blue line here, we would have seen a signal to get out. They say that this is a trigger to get you out of the S&P 500 on March 2nd. So let's see. We tried to retake, and then on March 5th, this 5-day period, we dipped below the 200-day moving average, and the time to get back in was around here. Definitely not what I was expecting in terms of June. In June here, this is between the 527 here and 626 here. It passes above the moving average. So let's look at where we are right now. Flying high and above our moving average here. So that's why it doesn't look like we still might have 10 weeks of prosperity according to this article. Most people will use the S&P 500 index as their trigger, but Faber found it worked for all other assets such as REITs as well. Global investors may prefer the MSCI All Country World Index. Is the system guaranteed to work? Of course not, but nor is anything else. In my opinion, yeah, what we just empirically saw was that you're likely going to still miss a good amount of the squeeze, if you, not the squeeze, a good amount of the price action downward, because you're still going to miss like a third of that price action. Let's look once more at the chart here. Look at this price action downward right here, right? You're looking at a third of it being caught by the 200-day MA. Like if you waited this long, you would have missed a third of the price action down anyway. So there must be a better way. Well, that's why we go bell to bell and actually teach you guys how to use cheat code. And now we're going to do a very quick, because this article said, right, we needed to be able to predict the financial crisis in 2020 for the pandemic. Let's put SPY here and see if cheat code would have been able to predict it. I have no idea. Let's take a look. I'm excited. Let's go to the daily. And February 2020 is here. So February 2020, there is, let's count, 1 sell signal, 2 in the Bollinger Band, and 3 right here. Right? So that was a sell signal. 4 out of 4. This is another 4 out of 4 sell signal. A little earlier, it would have gotten you out at 335 and saved you all this 30% drop from 335 to 220. So it seems like if we were going to take the rule of thumb with the 200-day moving average, we would have lost an additional 10-15% here when it was going to be too late. So cheat code seems like it predicted the secret here of when to get out of the market. That said, there are more 4 out of 4 signals, so it's not like it's a perfect predictor. Use it with a grain of salt, but we were asking the question here, would cheat code have predicted this March global pandemic crisis? And yes, if you took this 4 out of 4 sell signal, you would have been out scot-free. So thank you guys for watching this video. I want to thank the people who make this show possible, like the Moon Platoon over there, the Meatball Space Legend tiers, and the Grillionaire tier right up there. Thank you for joining on the trip to the moon. Meatball is happy, I'm happy, and if you guys haven't gotten a chance to look at cheat code, it's in the description down below. Make sure to use our partnership link, and if you guys haven't had 2 free stocks from Webull, then description below, $250 of free Bitcoin in the description below as well. Have a good day. Peace.